In a deferred Section 1031 exchange, you sell first and buy later. The IRS lets you defer gain, but only if you follow the timeline perfectly. Two deadlines drive almost every exam question: the 45-day identification rule and the 180-day receipt rule. Miss either one, and the whole thing collapses into a taxable sale. On the EA exam, they love testing the earlier of language. Day 1 is the date you transfer the relinquished property, usually the closing date. From that date, count calendar days, not business days. Weekends and holidays do not pause the clock. By day 45, you must identify the replacement property in writing, signed, and delivered to the right party, typically the qualified intermediary or another permitted party in the exchange documents. You can also satisfy identification by actually receiving the replacement within 45 days. Next is the receipt deadline. In a deferred exchange, you must receive the replacement property by the earlier of two dates: the 180th day after the transfer or the due date of your tax return for that year, including extensions. That including extensions is the trap. If your return due date would cut the 180 days short, you generally extend the return to preserve the full 180-day window. Here's the clean way to think about counting. Start counting the day after the transfer date as day 1 and keep going straight through weekends and holidays. If day 45 lands on a Sunday, too bad. Your identification still must be timely. The only real relief is limited disaster relief when the IRS announces extensions for affected taxpayers. On the exam, assume no relief unless the fact pattern explicitly gives it. A qualified intermediary, or QI, is typically required in a deferred exchange because you cannot have actual or constructive receipt of the sale proceeds. If the cash hits your hands, or your account, you've basically blown the exchange. The QI steps in to hold the proceeds and use them to acquire the replacement property for you. In real life, escrow may handle mechanics, but the key exam idea is you must avoid receipt of funds. Reporting is done on Form 8824, like-kind exchanges. You're documenting the dates, transfer date, identification, and receipt, plus the properties exchanged, any cash or other non-like-kind property received, and the realized versus recognized gain. Form 8824 also drives basis in the replacement property, which is how the gain gets deferred into the new asset. Exam tip: if you see boot, think recognized gain up to boot. Ethan is the sole member of Harbor Bullion, LLC, and he's a professional dealer of collectible coins and precious metals. A customer buys 15 gold coins for $13,200. The customer pays $6,200 in cash and the rest with a $7,000 cashier's check. What reporting obligation does Ethan have for this transaction? Options include only reporting on Schedule C, filing Form 8300, reporting on Schedule D, or filing an FBAR. Think about it. The best answer is that Ethan must file Form 8300 within 15 days after the transaction. A trade or business that receives more than $10,000 in cash in one transaction or related transactions has to report it. The tempting wrong answer is just Schedule C, because yes, it's business income. But Form 8300 is a separate cash reporting requirement, and certain monetary instruments like cashier's checks can count as cash here. What is the deadline to file Form 5500, the annual return and report of an employee benefit plan? The choices are various versions of the 15th day of a month after the plan year ends, or the last day of the 7th month after the plan year ends. Think about the standard due date rule. The correct answer is the last day of the 7th month after the end of the plan year. For a calendar year plan, that's July 31st. A tempting wrong answer is the 15th day of the 7th month, because many tax forms use the 15th, but Form 5500 is generally due on the last day of that 7th month.